I'm Matt Clark, research analyst for Money and Markets. This is your Bull and the Bear podcast as we head into the Thanksgiving week. Just, I guess, a programming note, even though we're on YouTube and on podcast channels, we will not be having a podcast next week as we are going to kind of take the week off and enjoy time with our families over the Thanksgiving break. So this will kind of be the last one for about a week, but that's all right. I think we've got some good information scheduled for you. Leading into it, we look at a lot of different sectors and they range all over the place, but there's been one that we really haven't touched on a whole lot. And that is the real estate sector. Now, first off, overall, the real estate sector has really underperformed the broader S&P 500 over the last 12 months. The index value of the S&P 500 has jumped about 15.6%, give or take. But if you look at the real estate sector, Spider Fund trades on the New York Stock Exchange under XLRE. You'll see the value is dropped by a negative 2.55% over the same period. So basically, there is about a 17 to 18% gap between where the S&P has climbed and where the Real Estate Select Spider Fund is at right now. And let's be honest, investing in real estate isn't necessarily the easiest proposition out there. You've got to decide what kind of real estate you want to invest in. Do you want to invest in land? Do you want to invest in construction, property development? Do you want to just buy houses and flip them? There's all sorts of things out there that you can make money at in terms of investing. But there is a way that I think you can get into the real estate sector and earn solid profits over the long term. And I want to stress that it's over the long term. It's not a quick in, quick out, 300% gain. That's not what we're talking about today. What we're talking about is something that you can get into that will provide you more steady, long-term gains as opposed to quick hits. And what I'm talking about are real estate investment trusts. They're otherwise known as REITs, R-E-I-T-S. REITs are basically companies that own and most oftentimes operate income-producing real estate. The categories that they operate in vary. There's office space, there's apartments, warehouses, hospitals, shopping centers, hotels. There's even REITs for commercial forests. So there are, if it is real estate, there's most likely a REIT involved with it. Multifamily housing, single family development. I mean, there's REITs everywhere. And it's important to point out that one of the reasons why I want to talk about this is because some of these categories of REITs are actually outperforming the broader S&P 500 based on returns, despite the fact that real estate is actually down. Now, if you're on YouTube, I'm going to show a little chart here on REIT subgroup performance versus the S&P 500. If you listen to us on podcast, I'll kind of explain it to you. What I did is I looked at 8 different sectors: office, industrial, retail, residential, diversified healthcare, lodging, and self-storage REIT performances. And each and every one of those groups since 1994 to 2019 has outperformed the average return of the S&P 500. You've got office REITs, which have given an average return of about 12.9%, industrial at 14.1%, retail at 12%, residential at 13.7%, diversified 9.8%, healthcare 13.4%, lodging and resorts 10.2%, self-storage 16.7%. It's important to keep in mind here that in that same time period from 1994 to 2019, the average return of the S&P 500 was just 9.3%. So there's basically 8 subgroups of REITs here that I could find that are actually performing better, and in some cases way better, than the S&P 500, despite, again, the overall real estate market in terms of stocks being down over the last 12 months. So today I want to break down a couple of REITs with Money Markets contributor Charles Sizemore, who you can see on the screen next to me, or you'll be able to hear here shortly, to determine if these are kind of strong buys or ones to stay away from. And first, Charles, I guess I want to get your take on REITs and the real estate market, and give me your thoughts there. I mean, I laid out a lot of things there, and I kind of want to get your take.
Yeah, sure. Yeah, you said, REITs for, every kind of real estate you can imagine, there's a REIT for it. There's actually a document storage REIT, believe it or not. There is literally a REIT that does nothing but have file boxes and file boxes and file boxes of junk from assorted companies and law firms and whatnot. And that's a REIT. But as a general rule, I do like the sector a lot. I always have. There are certain tax advantages to investing in REITs. It's really the best way to get into real estate. Personally, I don't want to be getting a call at 3 o'clock in the morning to fix a toilet. That's just not something I'm willing to do.
Property management just is not that appealing.
No, it's not
to me either. I would much rather just stay away from that completely. It's kind of one of the reasons why I rent now, because I don't really want to have to worry about that. I have other things to do. And
when you get tired of the place, you can just torch it and leave.
Basically, yeah.
just like a 1980s rock star just torching a hotel and leave. I mean, it's,
exactly.
But no, REITs are great. I actually think REITs should be in every retirement portfolio. Kind of the percentage of the portfolio they should be will vary from investor to investor. But I really can't envision any investor that shouldn't have at least a little bit of REITs in their portfolio.
And I agree. I think it's definitely important to look at. And there's so many of them out there. I mean, you think that, maybe it's a very limited market. It's really not. I mean, we've talked about how many different sectors REITs are actually in, including commercial paper storage. So, I mean, it just goes to show you that there are an abundance of REITs out there. We're just going to talk about two today. And these are two that are relatively big. And I picked them for that reason, just because you're probably going to know them if you have done any type of research or looking into REITs at all. The first one is actually one of the largest in the world. It's got a market cap of about $106.2 billion rather. It focuses on communications real estate for things like cell towers. It's got a portfolio of nearly 181,000 sites. Which is a massive portfolio. Its 5-year annual sales growth rate is 13%. In 2019, it had $7.5 billion in sales. In terms of earnings, the company has a 3-year earnings per share growth rate of 29%. It reported earnings surprises in each of the last 2 quarters, which would be 18% and 23% respectively. The REIT here is American Tower Corporation. It trades on the New York Stock Exchange under AMT. And Charles, you look at the stock chart here, and obviously, just like every other stock, it had a nice bounce in March. But this one here is kind of trading a little sideways and has been since about July. It's had some peaks and valleys, but I think it's kind of moved more in terms of the market. So first off, tell me what you think about American and whether you think it's a possible investment opportunity.
I love it. This is a stock I've liked for a long time. My complaint about it, if I'm going to have any complaint, is that it's not particularly cheap. But I could have made that same comment several years ago. So this is a REIT that has been expensive relative to its peers basically forever, but it's expensive for a reason. At the end of the day, cell towers are the ideal real estate holding. I mean, there's really, you're not. What do you do? I mean, you're just cell tower for crying out loud.
If you consider the fact that we're looking at 5G and how narrow that how narrow the distance between towers is there, you've got to think that in terms of needing more space, that AMT, if they're aggressive, is going to buy up more space for potential cell towers and really take advantage of a 5G.
Oh, sure. What I mean is it's a low maintenance business. I mean,
absolutely.
I think it's fantastic, and some real estate will never be obsolete. But as we've seen this year, and what we've seen for several years leading up to this year, but particularly this year, with all the COVID lockdowns and whatnot, is that while real estate may not be obsolete, we certainly have too much of it in certain sectors. Don't really need as much retail space as we have, for example. But something like cell towers, that's demand for that will not be shrinking anytime soon, if ever. I mean, not in our lifetimes anyway. Someday, new technology will probably come and make cell towers obsolete. I don't know that you and I will be alive by then.
Probably not.
So probably not. So I think this is one of those great sort of long-term holdings. I probably wouldn't jump in with both feet today simply because it is a little on the pricey side. I might make it a half position or kind of average in or something. Right. But I do love it. I think it's a great long-term holding.
It is, and I agree with you. Despite the fact that it is trading a bit sideways, it hasn't really been able to match any type of strong momentum coming off of its March highs. It is priced very high. I think its P/E ratio is right around 56. The industry average for REITs is around 33. So, but again, if you look at the broader market, what's not overpriced at this point? I mean, there's a lot of things that are overpriced. Yeah,
find something, right?
So, it would be interesting to find, is there something that's not overpriced by, it doesn't have a PE ratio of 3 to 4 and that isn't a stock that you know of. If we look at a chief investment strategist, Adam Odell, 6-factor green zone ranking system, American Tower actually ranks a 55, and there's a reason why. It's not because it's bad, and it certainly doesn't, I don't think, change our recommendation in terms of whether we think it's a buy or not. But the value is a little low. But you have to understand how REITs work. REITs are going to carry a lot of debt, just because that's just the nature of the real estate business. And the size, again, we've got a company here that has a market cap of $106 billion. So clearly it's going to rank very low in size. But if you strip those two factors out, you've got momentum. We've talked about that. It's a little above the mid-range in momentum. But if you look at volatility, the volatility is very low. It scores a 93 on volatility. Quality, it is around a 68, which is above the mid-range, and then growth is an 87, which is way above the mid-range. So if you strip out the two factors that we know are going to REITs are probably going to rank low on in terms of size and most definitely value, just because of that debt.
Well, I would actually throw in quality as well. I would say that even though this stock has a solid quality rating, I would say it's actually somewhat handicapped there, because our quality rating focuses on GAAP profitability, GAAP earnings, profitability for the most part, and balance sheet management. And REITs always look over leveraged on paper because they're real estate. I mean,
exactly.
They always have. And so I would say, if you were to normalize the quality rating here, for REITs, and I'm not really sure how to do that. That's kind of a long, geeky quant conversation to have with Adam. But I would say that this stock is actually, its true quality is a little bit higher than the model would suggest.
Right. But yeah, but if you strip those out, and even if you don't, I still don't think that takes away because you have to know the model, and Charles and I both know the model. So it's easy for us to say, okay, it may score 55, but there's this, and this. And that's what we're trying to do here is, when you look at it, you're going to see a 55, maybe a 54, 56 day change or whatever. But still, I think American Tower is definitely worth an investment pick. Again, it is pricey. It's upwards of $240 a share. So it's probably not one of those you want to liquidate the rest of your portfolio to get into. You want to, kind of keep this marginalized to a degree. You don't want to just, as Charles said, jump in with both feet, just because, it is pricey. And if you're looking at a pie and you're going to have to sell something to add to this position, well, you just have to consider that very carefully. So American Tower, both a buy for both of us here. Now, the next one I want to talk about, this is a REIT that I learned about a couple years ago just because it focuses on logistics real estate. Now, that may sound odd, but let me give you a thought. Think of online fulfillment warehouses. So if you think of that last mile delivery, you have a product that's manufactured in, let's say, here in Florida, but I'm shipping it to California, and I ship a lot of products to California. Well, direct ship is kind of inconvenient because of the volume that I have. So I need to have a warehouse that I can put this product in that's close to California, where I have, let's say 50% of my orders. And that way I have quicker delivery to the end user. That's what this REIT specializes in. It's logistics real estate, like retail and online fulfillment warehouses, B2B warehouses, so business to business product warehouses. It's got about 976 million square feet of property in 19 countries. It's got a customer base of about 5,500. 1-year annual sales growth rate of 25.4%. In 2019, it registered sales of $3.3 billion. So it's not quite the size of American Tower. It's a little bit smaller, but still, it's a good size. It's a good size company. As for earnings, the company's reported earnings surprises in each of the last 5 quarters. So it has beat Wall Street consensus in each of the last 5 quarters. 5-year annual earnings per share growth rate, 14.16%. This company is Prologis Incorporated, trades on the New York Stock Exchange under the ticker PLD. And this one here, a little bit different from American Tower. First off, it's in a completely different sector. But if you look at the stock chart here, we see a little bit different in terms of momentum. AMT, was moving a little bit sideways. Here, we see the same thing, but the downs are not nearly as much, and the ups are a little bit higher. So a little bit different take here, but not too different. Charles, your thoughts on Prologis?
I will answer your question with a question of my own. Okay. 5 years from now, will you be buying more or less online?
More.
Of course, we all will. Like if there's any, trend.
No-brainer.
And the pandemic only reinforced this. I don't know that I'll ever go to a store again because I have gotten so spoiled with just clicking a mouse and having something, not even a mouse, this one, just clicking my phone and having it show up at my doorstep.
2 days delivery. I mean, if I can,
well, you're slacking. I mean, I usually get stuff next day.
I know. If I can get past my need for instant gratification, then online
I can't.
I'm the same. I can't either. I stand at the door and wait, and I kind of freak out the Amazon guy or whatever. But yeah, online, we've seen it during the coronavirus lockdowns. Stores made major pivots towards e-commerce. And there's a reason why. It's because if we're faced with lockdowns or whatever, that's the only way these companies are going to make money when your store's closed.
But then looking beyond that, once consumers get used to that convenience, they're not going back, right?
Exactly.
It's very. I mean,
now that we're trained in that, trying to go out and go to a store just doesn't make any sense when I can either have someone go and do the shopping for me and deliver it, or I can order online, click a mouse or tap my phone, and it magically
appears
and have something either the same day or in 2 days, or just even if it's 5 days, whatever, doesn't matter. But yeah,
so the way I look at this REIT is this is the underbelly of the e-economy.
Absolutely.
So, it's the sexy stuff is Amazon.com. That's the glamorous, sexy stuff.
Exactly.
This is the boring, non-sexy, fulfillment aspects of the e-economy.
But it is the most important part of the e-commerce.
Oh yeah. There is no Amazon. There is no online economy without this company and its competitors. So that's a very long-winded way of saying that I really like this one a lot. My only hesitation at all is, just as with American Tower, it is a little on the pricey side. So I would say this is a good one to buy and hold forever. You may just want to average in, instead of buying whatever. If you're going to buy 100 shares, don't buy 100 shares all at one time. Maybe buy 20 shares today and average in over the next year or whatnot. But
tranche your buys, don't go all in all at once.
Yeah, space them out. But I think this is a stock. There's very few stocks out there that I could say, yeah, I could see myself owning that 20 years from now. I could see myself owning this 20 years from now. It's a solid REIT. It makes it's benefiting from the biggest trends of our lifetime, and it's well run. They have a great management team that's been doing this for a long time. So I am a fan,
and I am too. And again, this is going to be a very similar situation to what we had with American Tower. If we look at Adam's 6-factor green zone ranking system, Prologis actually ranks lower than American Tower. But again, that's because it ranks low in size. It ranks low in value, as REITs typically do, and its quality is a bit lower than American Tower, which is why we have.
I want to elaborate on the value thing real quick. We sort of touched on it. Elaborate on it a bit more. Why are REITs punished on the value score? And
I think it's important to do that. Yeah, absolutely.
Yeah, it comes down to GAAP earnings and what happened, and that's generally accepted accounting principles. And don't worry, I'm not going to give an accounting lecture. We'll lose all of our subscribers if I did that. But REITs have massive non-cash expenses in the form of depreciation. And so even though REITs make money, I mean, they cash flow, like the money is in the bank. You can count it. You can count the dollars.
It's a pretty consistent stream of money.
Exactly. But on paper, they always look like they lose money or they don't make much. And it's a tax game. There is a reason why people get rich in real estate, because it has the most advantageous taxing in the world. Even though real estate goes up in value most years, for tax purposes, it declines in value. And so REITs in general are going to just have awful earnings numbers, because of those non-cash expenses. So that's a big part of that.
Right. And it certainly isn't because they aren't making money. It certainly isn't because they're not paying out dividends, because they are. For dividend percentage for Prologis, about 2.2%, a little lower than I think where we'd like to see it, but it's still a very good.
If that yield ever got up to 3, I would mortgage my house and sell my car to
own Prologis,
push more into that stock.
Right.
I think it's a fair buy at current prices. It's not that run out and sell a kidney to buy more shares level, but it's still reasonable.
And the one thing, if you notice with both of these REITs we've talked about here, is their volatility is extremely low. And to me, as an investor, I think that's very important to understand. Stocks have been bouncing all over the place, whether it be on coronavirus vaccine news, whether it be on the election. I mean, the markets have been fluctuating pretty vastly. But one of the things, there's several sectors that are consistently, strong and not volatile, but one of those are REITs. REITs they're not really that volatile. Unless it's a major announcement.
Well, and these in particular, not all REITs are the same.
Right.
Some REITs are more volatile than others.
These two in particular, however, are not volatile hardly at all.
Not.
So these are good, these are good plays for the long haul. These are, like I said from the top, these are not ones you want to get in and try to get out quickly and find quick profits, because you're probably not. You're going to find profits over the course of term. And that term
of a lifetime, of an investing lifetime.
Yeah, you're looking at 15, 20 years probably. Prologis' price point is a bit more advantageous than American Tower. Right now it's about $102, $103 a share. So that's, more than half the cost of American Tower. But, I think both of these REITs are strong, and one or both of them would probably do your investment portfolio a lot of good. So I think we're both pretty solid buys on both Prologis and American Tower. Yeah, do you agree?
I would.
Very good. That's really about all we had. I just kind of want to get into, it's a little bit different avenue than what we're used to talking about. But, as we head into the Thanksgiving holiday, just kind of wanted to end off on that note. And with that said, I do want to say that from Adam O'Dell, Charles Sizemore, and myself, we do hope that you guys have a safe and happy holiday, and be very careful. I know that the coronavirus is stepping back up again and all that. So we want you to be safe above anything else. But again, I hope you have a very happy holiday, happy Thanksgiving. And we'll be back in a week's time. We will be back on with the Bull and the Bear podcast. So for Charles Sizemore, who, again, I appreciate his time each and every time he comes on, I'm Money Markets Research Analyst Matt Clark. Make sure you check out moneymarkets.com and sign up for our free e-letter. Very simple to do. Just go to moneymarkets.com, put in your email address, and you get a daily email from us. Charles writes on a regular basis. I write on a regular basis. Adam O'Dell's on there. Mike Carr's chart of the day. And that's what you get. We want to provide you safe and sound investment information to really bolster your portfolio and your profits. So make sure you check that out at moneymarkets.com. Again, hope everyone has a great holiday, and we'll be back in a week. Until then, I'm Matt Clark, wishing you all safe trading.